Yeah, I mean that's a great question because when you look at the chart, like if you overlay the assets under management or basically shares outstanding or whatever you want to look
Yeah.
at, it's really opposite of what tends to happen with equities, right? When equities start going down, people just start selling them, and
Yeah.
the overall AUM of the ETF or mutual fund or whatever you're looking at tends to go down. But this has been the opposite, right? People have just been like averaging down the whole way down.
Everyone, welcome to this week's NASDAQ Dorsey Wrap podcast. John Lewis here, special guest. John, how long have you been with? I was going to ask you before we started, how long have you been with Dorsey right now?
I started in 2002, in June of 2002.
So 20 years.
Yeah, over 20
So
years. But for those of you who study market history, that was not really a great time to start in the business. The summer of 2002 was not ideal. So
yeah,
yeah,
seriously.
it was not good.
Yeah, well, point being, he's got a lot of good experience. He's like a veteran here for a while. So, and he was in the office in Richmond. If you're watching on YouTube, we're sitting across from each other. So I figured we'd get him in for the podcast, share his thoughts about what's going on in the market, just for timestamp. And like I said, we're talking Thursday, October 19th. This will come out on the 20th. But just generally, John, I know we were talking before, lay of the land for the market. There's a lot of sentiment discussion that we've been having with clients, year end, quarterly earnings. Where would you kind of want to start if you were to share your thoughts on what's going well for the market, what's not going well?
Yeah, so I guess what's going well, we are heading into a seasonally strong period, right? The end of the year is usually pretty strong. People start looking out to next year, right? They're kind of done with 2023. They're looking out to 2024 once we get through earnings season. So I think that's why it's usually pretty, like a pretty seasonally strong period. We've had some indicators reverse up, right? So I think that's a decent sign. But on the con side, there's still kind of a lot of overhang out there. So I think the sentiment is tough. People don't know what the Fed's going to do. Fixed income is really having difficulties. We've seen this incredible collapse in long-term treasuries that's getting a lot of play, like on Twitter now and things like
Yeah.
that. But one thing I thought was interesting, that I hadn't even thought of is this drawdown in something like TLT or 20 plus year US treasuries is getting around what we saw in like equities in 2008 2002, but people don't seem to be panicked like they were back when equities were really having problems. So maybe they figure they can just hold these bonds and finally get their $1,000 back or whatever. But it's a very strange dynamic out there, and I'm not really sure what to make about that.
Yeah. So for something like the TLT trade, because we've talked about that, we've been looking at that chart as well. Do you think that's just speculators betting that long-term yields are going to come down, or is that people actually, how much is it of that is like a short-term trade versus like a longer-term positioning?
Yeah, I mean that's a great question because when you look at the chart, like if you overlay the assets under management or basically shares outstanding or whatever you want to look
Yeah.
at, it's really opposite of what tends to happen with equities, right? When equities start going down, people just start selling them,
Yeah.
and the overall AUM of the ETF or mutual fund or whatever you're looking at tends to go down. But this has been the opposite, right? People have just been like averaging down the whole way down. And so I've heard a couple theories like, hey, maybe these are really like insurance companies that own this and they don't, they're liability matching and they don't really need the money right away. So it doesn't matter. I'm not sure I really believe that. I think it's more like what you mentioned. Like, I think people think the economy is going to roll over. I think
Duration trade.
yeah, and like people I think are really convinced that a recession is coming. But the economy's been incredibly resilient, especially the consumer. The spending continues to roll. We haven't seen really any cracks there. We haven't seen major cracks in like high yield spreads and things like that. I really thought we could see something at the beginning of the year with the bank problems when Silicon Valley Bank went under and SBNY went under, but that didn't seem to derail it either. And so, I mean, I don't really know people must think that we're going to have much lower rates, but it hasn't materialized.
Yeah. Yeah, I've been talking about rates as well, looking at like the 10-year yield that's breaking out again today to the upside. And then if you look closer on the 2-year yield, that's like stuck at a multi-decade high. So I know maybe some of our fixed income strategies, fixed income models, we've been on that shorter end of the curve for a while now. We're not really going out like the TLT, maybe some of those investors, and being more speculative about some type of mean reversion. We've kind of stayed on that shorter side of the trade. Do you think that's a position that will stay, and like our indicators and models would still stay on that side for now?
Yeah, I mean, I would assume so, right? I mean, we have, as you mentioned, like 10-year yields are like breaking to fresh highs, and it's going to take some mean reversion there, or some significant reversal for us to switch all that in the models, right? Just because all of this stuff, whether it's fixed income, commodities, equities, all of this trend following stuff does require some sort of reversal in order for us to switch the models. And, if you've listened to what we've talked about over the years, I mean, that's really, you have to do that, or else you wind up killing yourself with the paper cuts if you're trading like too frequently. And so I would think this kind of shorter duration trade is here for a while, just given the fact that we would have to see kind of a significant reversal in order for us to just make those big changes in the models.
Yeah. And I was just thinking too, would that be good for like active managers? Because a lot of the bond benchmarks have had increasingly higher durations, or the average composition of the bonds that they hold have been longer and longer in terms of their maturity. So if shorter end is kind of the place to be, do you think that's kind of good if you're like if you benchmark to the ag? I assume that would be an easier thing to compete with now.
Yeah, I guess that though depends on what kind of leeway you have in your portfolio, right? I think there's a lot of really constrained active fixed income portfolios out there. And I think there are a lot of fixed income managers that aren't willing to make kind of the big shifts that we do on a technical basis. I think they're doing a lot more credit analysis and economic analysis and stuff like that. And we're trying to really make hay by shifting around to these different areas of the bond market in pretty significant size. So I think for us, it's an interesting point, right? If duration keeps getting longer in these benchmarks and shorter's where you want to be, that does make it easier. Although the reality is, like, if we're jammed all in kind of short duration stuff, that means the bond market's not doing well.
Yeah.
And at some point, those cracks hit too, and people just don't want to deal with this kind of historic drawdown that we're seeing in bonds, and they're going to just want it in cash or in something else.
Yeah.
So there's, I think, a lot of competing factors there.
That's a good point. Yeah. Going back to what you're saying before about like sentiment not following price for something like TLT versus equities, that's typically what you see. Market breaks out, bullish sentiment starts to tick up a little bit. Market rolls over, bearish sentiment starts to tick up. So in terms of like equity sentiment, you mentioned seasonal year end is typically people get not necessarily euphoric, but more bullish heading into year end, more optimistic. The equity indices, I don't know if they've been as helpful for sentiment. I feel like I've said this before in podcast feels like one of the most hated bull markets. Should we, maybe we are in a bull market by definition, but like one of the most hated bull markets, people just keep trying to point out issues with equities, which is fine. I'm sure there's plenty of issues, but like you said, some of our shorter term indicators have started ticking up. Some of the major benchmarks still pretty range bound, but looking like they have some room to run. I got, like, for example, I'll get you guys like Russell 2000, S&P equal weight. Those are super range bound, but they're at the bottom of a trading range. So maybe it doesn't look like that you break down out of that trading range, and maybe you start to tick up a little bit towards the back of the middle of those. Sentiment starts to follow. I don't know how much that can materialize, but it seems decently constructive for now, at least.
Yeah, I mean, so the sentiment question is always difficult, and we are starting to see some decent signs in there, but it would be nice to see some of these, like either small caps or equal weight or whatever, start to catch up with something like the Qs or the S&P, where it's just been so dominated by a few large cap names. And realistically, I mean, everyone talks about the health of the market, this, that, and the other, but the reality is you tunned it in those things, right? Even with the other stuff not working. But, eventually, I think I would like to see things broaden out. And I think that will really help active management, right? Because there'll be kind of a bigger opportunity set to capitalize on. It's been a really narrow set to capitalize on, which oftentimes is very good for momentum because you can just own those handful of stocks. The big problem this year is that they had come from such a beaten down place and in such like a laggard status at the beginning of the year. It just took a long time to start getting that stuff into momentum and relative strength models. So that's been the problem more, I think, for momentum than like the narrowness of it. A lot of times you can capitalize on that with a concentrated strategy, but it's been super hard this year because that reversal was really, really strong. And that laggard rally was really strong at the beginning of the year.
Yeah. Yeah. So you're saying essentially from like this point last year was effectively the intermediate term low that we've put in for the SP was like 3,500 or so in October of 22. Essentially from that point, and you sent me data this morning on it, it's pretty much everything that wasn't working immediately began working, almost like a light switch.
Yeah.
So you had these relative strength charts that were deep columns of O's and then an immediate column of X's back up. So it's to your point, like it's just taken a long time to pick up on the new leadership.
Yeah, for sure. So and people, always wonder like how this stuff works. Well, when you get these laggards really starting to move, one of two things happens, right? Either they peter out and they don't become leaders, right? And I think that example, is this year anyway, like more like the banks and the regional banks and stuff, like they got destroyed at the beginning of the year, bounced up, everyone was on it, and then kind of rolled over again, right? The flip side is like comm services and tech. That stuff was all at the bottom and it starts to rally. And then what happened to those is it didn't peter out, it became the leadership. And then that stuff starts going into a lot of your sector rotation model or your stock model or whatever. You just kind of miss that first part of the move. It's never pretty, right? When you miss that, but that could have very easily been like the regional banks that had a good run and then kind of rolled over again. So it's an interesting situation. There's kind of nothing you can do to avoid it if you're going to do this. If you really want to get stuff off the bottom, you really have to go with some sort of like value-based or mean reversion type of strategy, right? These trend following things don't work like right at the turn.
Right. So in your experience of, like you said, like 20 plus years and all the markets that you've studied, does the current environment remind you of anything in the past broadly or even specific about momentum? And it's just kind of continued flailing.
Yeah, I mean this one has been pretty historic. I haven't really seen momentum be like this out of favor for so long for a while. And I think a lot of that gets back to what's going on with the Fed and rising rates, and that there's just like so much uncertainty out there with what's going to happen. And I think that's ultimately just an unwinding of people having rates or the Fed keeping rates artificially low for so long, right? And something had to change in that had to unwind. But it seems like there's, as you mentioned, like it's the most hated bull market out there. It's like they're not willing to see the trends continue, right? They'll, oh, this sky is falling, we're going to get out. So there's just been so much back and forth kind of choppy action. We've seen this like a number of times, right? When momentum is underperformed. I don't think it's been by this much. And it's kind of the double whammy of, like this narrow opportunity set in the S&P really making it so, but we've had crazy periods like 2009, that laggard bounce was unbelievable. 2003, that bounce, if the old line Dorsey Wright subscribers remember that one, because that was really why we changed the relative strength charts over to a percentage based box from the old Chartcraft boxes that are still on the price charts, right? But those things had been so compressed with the 2002 sell-off that it was taking these massive relative moves to get them to switch on those old like Chartcraft. But so, they would be at like, 0.25% or something box size because they've been so compressed. So anyway, that's the story, or that was kind of the impetus for why we went to that percentage deal. So that's pretty historic too. When
Mhm.
when we looked and we're like, okay, we really have to change. I mean, I'm not saying we're doing that now, right?
Right.
But that was another period where there was like this massive amount of underperformance. 2011, that was a little bit different because that was like a risk on, risk off deal. And you were like, oh, bonds are great. And then they weren't. And then equities were great. And the bonds were good again. So there was a lot of back and forth there. I think the thing that ties everything together is that you always do come out of it on the other end and things start trending one way or the other. There's going to be leadership. We just don't know where it's going to be. You just have to keep like pulling the trigger, I guess, for lack of a better term, and just kind of stick with what works. Because I think as soon as, when people start giving up on things, like that is the kind of the end, right?
Mm-hmm.
I mean, people throw in the towel at the end, always happens. And when I sit back and look at it, if you do a lot of stuff on the Dorsey Wright site, or you use managed accounts, or whatever, you're probably pretty familiar with how all this works. You're probably actually more comfortable with the underperformance than people that don't understand how it works.
Mm-hmm.
So this is generally like a good time to move money into this type of thing from something else. And so I think that's where, as a financial advisor, as somebody who wants like, good long-term performance, you can move that money over, and, it might not work for 6 months, but, longer term,
Yeah, 10
that's,
years.
it's like really the play to do something like that. So, that's how I tend to look at it. I know it's a lot harder when you're sitting across from a client, right? And the client's wondering. So that's a tough job. And, part of your job, when dealing with clients, is like that they trust you, right? And that they trust you've got their best interest in mind. And I think if you can articulate the story and talk about maybe why things are the way they are, I think that people are generally okay with that. There's certainly people that are unreasonable, and they're just going to be unreasonable about everything, right? So, what you can do with that. But, for the most part, I think people, if you know what you're doing, if you have a plan and you have a good way to explain it, they're pretty reasonable about stuff like this.
Yeah. And I was thinking too about momentum is super adaptive. It's self-corrective. It's not going to stay wrong for long periods of time. So it's like always working beneath the surface to pick out what's going to work. And two, and you've talked about this before, and Chuck as well, like it's really tied to investor behavior. There's a lot of investor biases that momentum exploits really well. So maybe there's, like you said, there's this period of investor behavior where people buy things, it's working, and then they dump it because they're afraid of whatever, or some news comes out or whatever changes. So there's been these periods of back and forth investor behavior. So, I mean, I'm assuming people don't change over decades of time. Human behavior is very, very cyclical. So that's a tailwind for momentum, in that, the factor's not broken by any means. People still behave more or less the same as they have before. It's just a period of tough. It's just a tough period to watch. You're kind of waiting on things to go back to normal for trend following, and maybe it looks a little bit different going forward.
Yeah, I mean, maybe, but you're right. So it's a really good point that, people historically haven't really changed that much psychologically, and this does exploit that. I can't even tell you how many times we've taken phone calls and they lead off with your model's broken.
Yeah.
And it's not really broken. It's just like not working right now. But longer term, this stuff works. And we've done so much research here. You guys have been part of that. Chuck's done a bunch. I've done a bunch. Everyone has done this. And no matter what we throw at it in terms of a calculation, right? It's just the idea of getting the losers out and trying to capture as many of those long-term winners as you can.
Yeah.
That's what works, right? And so, those long-term winners will be there, right? We just got to wait and find them, and then we'll be off and running. So, yeah.
Well, good. I know we're about to go get a burger for lunch. So, anything else you wanted to end with? General thoughts on market, pros, cons, anything, any one-liners?
No, I don't know if I have any one-liners. My one-liners have been wrung out of me, and this is when maybe we're getting near the end, right? I mean, it really has been a difficult environment for people, and I think that these are the times that where sticking to your process is really like super important. And I can remember back to the late 90s when everybody said the world had passed Warren Buffett by, and then all of a sudden, Berkshire Hathaway was on a tear while all these tech stocks were getting demolished. And so, I'm not saying that's going to happen right away, but there will be a change in the market. People have written off small caps, they've written off international, they've written off all this stuff. It'll come back, right? And so I think just being very kind of vigilant about what's going on and not taking this like personally, right? I mean, this stuff happens, just kind of like following the indicators, following where the strength is. It's going to get you to the right place. And so we always have, I think, a little more confidence than people think we should or whatever, because, we've seen this movie, we've seen the sequel, and it's a little bit different every time, but the underlying human part of it doesn't change.
Yeah, that's cool. Well, thanks for taking a few minutes to come chat on the podcast before we get a burger and you fly out later.
Yeah, thanks for having me.
Cool. All right, everybody. Thanks for the time. We appreciate it. Other than that, we will talk to you all next week.